Hi, everyone. We're the Andrews Company. I'm Megan. This is Chris. And this is Alfredo. Our mission is to provide premium products that stand the test of time, ensuring value and satisfaction for our customers, stockholders, management, and employees. We chose to use a strategy of broad differentiator. This means that we maintain presence in both segments, adjusted our marketing decisions to have the highest customer awareness and accessibility possible. We also adjusted our accounts receivable and our price to try to earn the highest share of the market possible.
Okay, for some of our initiatives, we wanted to introduce multiple new sensors to the market over the rounds for a total of 5 by the end of the eighth round. We wanted to do revisions on each of those sensors that we did have in the market so they matched the customer segment preferences. We wanted to have at least one sensor each round at the very cutting edge of technology so that we would have the best sensor on the market. We wanted to offer our customers the best in industry AR terms. We extended those out to 60 days. We wanted to fund all of the TQM initiatives to maximize their effectiveness. So we put 750,000 to each initiative when they first came out. We did that the second year, and then we did 500,000 the third year, and then we did not throw any more funding into TQM as we maximized their potential. We wanted to utilize dividends to help reduce the days of working capital ratio that we had, and that moved it into the optimal range for us while providing shareholders with greater value. Our biggest challenge has been the Baldwin Company. They just have seemed to have some of the same strategies that we've used, and you can see down below that we kind of started neck and neck, and then they took off a little, and we caught up a bit. They've been our biggest challenge in terms of trying to negotiate our price and our performance metrics. Some of the other challenges are differentiating our products and offerings from the other companies in the industry. We're all kind of have the same market segment, so we're trying to differentiate ourselves. We want to find the right balance between price and product specifications. Forecasting sales has been a challenge, especially in a dense market with further product introductions each year, trying to accurately forecast what we think our different sensors will sell for. And then, of course, production projections based on those sales forecasts. And then some of the difficulty in the forecasting for projection and whether they're low tech, high tech is the changes in drift rate for both the low tech and high tech. High tech tends to drift at a faster speed than the low tech was drifting. So we wanted to make sure that our high tech products could move faster than our low tech products needed to move. And then changes in the growth rate for both low tech and high tech. So low tech's growth rate in terms of the size of the market was slower than the growth in the high tech. So by the end of rounds, we wanted to make sure that we were capturing more of that high tech that was growing at a faster rate. To begin with, equal starting for all companies in the industry. There were companies who wanted to win market share with prices. There are companies that want to win market share with cutting edge technology and customer optimal preferences. All the companies competing for the same customers in the same segments. New sensors were entering the market every single year. Sales forecasts are difficult for all the companies, and they can lead to big opportunities in stockouts or an overabundance of unsold product, often leading to emergency loans. The inconsistent strategies of some of our competitors led to some of those swings in inventory as well. We tried to project and think about what certain companies were doing, and they would change their strategy a little bit, and that sometimes came back to haunt us in the forecasting as well.
I will share now some details on important numbers of the company. We have the total revenue with the projections for round 7, which will give us a total revenue at the end of round 7 of $189 million. We have here some important information. The net income at the end of the round 6, which is $22,000 million. The stock price that is at 75.96, and the net change in cash that is 0. Here we have the total sales and the growth during the 6 rounds. We begin at almost $41,000 in round 0, and we ended by multiplying it a little bit more than 3 times, which give us $135 million of total sales at the end of round 6. We strive really hard to get as much market share as possible, to try to give the best products to our customers. And at the end of round 6, we ended up by having 22%, which are hardest to keep it that high or to increase it. Stock price, we begin the round 0 with the price at $11.19, and we ended up at the round 6 by multiplying it by 7, which give us the price of the stock at 75.96.
These are the products and their positions throughout the rounds. We started with a low-tech product, and then we introduced a high-tech product right away. Following the broad differentiator strategy, we wanted to make sure that we had products in both segments. As the rounds progressed, we introduced new high-tech products and allowed older products to drift into low-tech. For our automation, we wanted to keep automation high for low-tech products that we did not plan to move much, and low for the products that we wanted to keep on the cutting edge. Here is the automation we set for each product through the rounds. Higher automation gave us lower labor costs, so we were able to get higher margins on the low-tech products. Thank you.